Back with another video again today. Today I wanted to talk a little bit about positioning shock, otherwise known as flow rebalancing. It's something I touched on in the previous videos a little bit. I want to get a little bit more in depth today about exactly some of the metrics or reasons why these portfolios need to manage risk. So the first thing we're going to talk about, well, all of these things I guess are a little bit in one. Options hedging, manipulation, Vega, and gamma is a little bit different, but these first three are along the same thing. So the first thing what we have is what our scene is. So we have volume targeting, volatility targeting with exposure ability. Yesterday we talked about balance sheets and bond yields. How much are these banks and these market dealers able to deal out in position sizing and volume per day, per session? Um, with that known, these portfolios must manage positions, and because of this, they're allotted in their movement by the amount of volatility and volumes presented in the market. This comes though with something a little bit different than just passive management. Um, Something called risk parity, and leverageability. The amount you were able to have open, the amount of positions that you were able to take, um, given your own risk yields and your own exposure abilities. We'll discuss risk parity quite quickly here. This is a study done by Duke EDU, Journal of Portfolio Management, the impact of volatility targeting. I didn't want to break this down too much. All I wanted to do was really reference, yeah, this section right here. This is a little bit important for us. Conditioning portfolio choice on volatility has attracted considerable recent attention. The financial media has zoomed in on the increasing popularity of risk parity funds. In recent work, Maria and Murr, 2017, found the volatility managed portfolios increased the Sharpe ratios in the case of broad equity market and a number of dynamic, mostly long short stock strategies. Now, we could break down how to utilize the Sharpe ratio, what that Sharpe ratio looks like in application. If we utilize that in ML learning, how we implement that in the trading. But overall, I'm just explaining more so the concepts. Right? Remember, we don't need to become quants ourselves. Right? You do not need to know every single metric, calculated metric, and proof theorem that these institutions are using to manage their assets. You don't need to know all of those things and compute them. Do mental math with those 9 variable proofs. Right? You don't need to do that. What you do need to understand is the system. All right, and the system is this. All right. Recently, a lot of these asset movers have moved from this passive form of management to this more specific risk parity funds. All right. Now we'll get on to risk parity funds. All right. Wait, wrong thing. All right, risk parity funds. Okay. This is the important thing that we need. Using this approach, the expectation is that the risk-return profile of a risk parity portfolio would be more attractive over the long term and less attracted to drawdowns and other risk concentrations than other asset allocation approaches where risk is not an explicit consideration. Given the attractiveness of this notion, it is not surprising that investments in these strategies have mushroomed in recent years. But with this influx of investor interest has come an increasing amount of criticism of certain aspects of these strategies. While numerous criticisms exist, one of the most common is that risk parity strategies have only performed well due to a bull market for bonds and that they leverage employed subjects investors to increase risk. Right? We believe these criticisms warrant a deeper look as they often reflect a lack of understanding of the underpinnings process and management of risk parity strategies. All right? I'm not going to go through this entire paper. This is a 10-page academic essay written by 2 PhD, I would guess, a president and a MD. So these guys are, probably pretty intelligent, as this is a quant investment group. And we're not going to go down through this whole paper. The only thing that I wanted to show this paper is the shift, I guess, from this passive management system to the adoption of this risk parity system where you're having um, you're having all of these uh, sorry, you're having all of these asset management firms who previously were investing based on a somewhat of a beta viewed system of risk comparable to that stock's market cap price. In that, like, for example, okay, if I have, right, I have, right, let's say Apple stock price, right, let's say it's equals 200, right, and let's say we then have, uh, uh, let's do, so what's something small, um, uh, just assume Walmart's smaller. Let's say Walmart's like 100. I have no idea what Walmart is. All right. Now, say that their market caps are, let's say we have what? 3 trillion. And let's make this, 300 billion. All right. Let's give them each a beta score. Let's see. Each just give them a theoretical beta score of 1. All right. Which should mean that um, both these stocks are pretty comparable in their risk to the census market portfolio. That's not realistic. It's not what you're going to expect to see, but we can just assume that from my explanation here, okay? If we have both of these beta scores the same, where Apple's stock price is double, but their market cap is 10 times, right? What we'd expect is that the position sizing of Apple is equal to that weight. In that, if we then have 20,000 stocks of Apple, or contracts of Apple, all right, to keep a passive portfolio, what we would have is then 4,000. Okay. Now, passively, this was tried to do within these ranges, okay, in the past, so that risk could consistently be managed at a lower degree and that exposure could be maintained and varied. Because this is also one of the rules in portfolio management is that a diversified portfolio is always better and always leads to decreased risk. All right. Even if, say for example, I had a portfolio of 18 stocks that all had an above 1 beta, but say that was below 1.1, say that was a 1.02 across 5 stocks. That is better than having, or sorry, no, it would be 0.98 then because it'd be flipped. So say all of our stocks had a 0.98 beta. It is better to hold positions in all of those stocks than to have 1 or 2 positions in a beta that had a stock beta with 1.2 or 1.15. Even though that risk on a arbitrage scale looks worse, the diversification um, comparative to how markets have moved in the past will always give you lower risk, always. Um, Now, going to talk in about other things. The point of why I want to reference this is previously why risk parity is important is risk parity introduced a system where previously you had typical portfolios of 90% stocks, ETFs, options, futures, and you had 10%, etc. Right? What risk parity does is it assigns certain metrics for every available asset and then takes the position of those weighted assets comparable to the risk. So at any time, that could be 60% stocks, 30% commodities, 10%, etc. Or it could look like our typical 90-90 cent. The percentages aren't that important. What is important though is what this Risk article goes down into, which is because you are basically taking more than just the typical growth portfolio, you are taking the full market census of stocks, ETFs, commodities, almost every tradable asset. What you're basically doing is what this says is in a stable bullish market, um, this performs well because you have large exposure, you have varied exposure, and you have appeared low risk, right? What this article goes into, though, and I'm not gonna go take a look and see for yourself, but it's something to note is if strategies are being abided now, where every industry or every sector of assets is being viewed at in an independent risk system, that shift of view gives suggestion that risk can be viewed generalizably, and it cannot. You have times where assets are moved into havens, where assets are moved out of havens, where assets are rotated through sectors. Um, those things are the nitty gritty, which keep whatever metric that you're using to follow this prosperity strategy, it keeps that equivalent. And honestly, I have not viewed for myself, but I could see an example or a world where even when this is true, where in shakier conditions prosperity falls short, you could still likely manage a profitable portfolio, um, as long as your volatility targeting and your position allocation are okay. Now we're gonna go into uh, multi-asset allocation or factoring model MAC3. Um, I wanted to talk a little bit about CAT, and I thought it's honestly what I looked up, but these are just the advantage. This is nothing, so I don't even know why I'm even showing this. Oh, CTA. This is yeah, okay. There we go. So um the CTA chart basically shows the adding in lessening of exposure, which can show the creation, uh, continuation, or decrease or the correction of a trend. All right. So what we see here, we see continuation through this bullish trend. All right. A slow of exposure, heavy de-exposure. All right, with a small correction. All right, because exposure is not directly price, which is why these graphs don't line up. But these graphs correlate and they explain the momentum of this white. Right? We can think about this very very loosely as a velocity and an acceleration graph. Right? Our QCTA, that is our acceleration. Right? That is how much the velocity is able to be increased at any given moment. And that is what our QCTA gives us. Right? When we see exposure jump, right, we can expect for prices to increase. When we see exposure rebound in such a way off of such a decline, or we're seeing, okay, sell pressure is being stopped, right? This could be a trend reversal, right? It's not. It's not so much so. We're seeing exposure like this here is where we're seeing, okay, trend stopping. All right, but if you're seeing this off this mega bounce, you if this is price, you're gonna see 50% retrace or almost, and go maybe trend ends here. The thing is, this was just a slow momentum. Trend didn't end until here, but we can use this QTCA as a forecaster for the amount that price is able to move, and given current price action, where we expect price to be allowed to move due to risk allocation. Um, And then typically, the last thing I wanted to talk about with position, uh, sorry, flow rebalancing and positioning shock, was options dealers. Um, so I reference this literature just a little bit, just so we can have something to say. But this is kind of a dense paper. We're not going to go into too much. I think we can kind of just pick out a little piece to give us a little bit of something though. In practice, a trader responsible for derivatives dependent on underlying asset does not have a great deal of discretion about delta hedging. The trader is usually required to eliminate or almost eliminate delta exposure each day. A more interesting decision that the trader has to make concerns the gamma and vega exposure. Gamma is the second partial derivative of the value portfolio with respect to the underlying asset and is a measure of exposure to large asset price changes. Vega is a partial derivative of the value of the portfolio with respect to the volatility of the asset price and is a measure of exposure to volatility changes. All right. Basically, what this article is then going to probably go into saying is delta is a lot harder to measure and it must be eliminated each day, which is interesting. Um, but gamma and vega can be utilized. And so we'll break down these two really quickly. So, what is delta? Delta is the change in option pricing relative to reflected asset change. Right. So here we have simple example. We have a 690 contract for the spot. 690 put contract for the spot. Say it's valued right now, or with an expiration date. Today's the 14th, so let's say next Friday. That's 6 days. Feb 20th. All right, and let's say that costs us $450. I don't know really what it does, but it's probably decently close. All right. Which is therefore $450 due to 100 contracts, unless you have a 10 contract size or a higher contract size. Most people are only doing 100 contracts for normal. You can take multiple put contracts, whatever. Okay. Point is, that's the price. Now say a SPY contract or a spider contract is, what is it at? Like I have it right here. 681. All right. Delta is equals. Okay, and we're gonna make these both variables just so they make sense. So we're gonna make this x2, and we're gonna make this x3. So delta equals so previous x2 minus x2 minus previous x3 minus x3, right? That's our delta, right? Now, why is this important at all? This is important because it shows us the difference between the value of the asset and the options value of the asset. How much the options market is viewing those contracts, and is that due to the asset's value itself, the institution's need to balance their positions? What is the case? Delta gives us that example of maybe this asset is being overvalued in terms of its options evaluation. Maybe it's being correctly valued, and if it is being correctly valued, why is there discrepancies? All right. Now, I'm not thinking I'm not going to go into the theorems of how to utilize delta exposure and delta as a metric in your options trading today. I was kind of just wanting to go over risk parity and risk systems. But we'll also talk about briefly gamma and vega. So, because I know the academic explanation was probably a little bit just, wordy buzzwords. All right. Gamma is change in delta relative to change in asset price. So if we think of delta as, um, you know, their x and y, where we have x here, right? We have y here, right? And then we have we can have we have options price, right? And we can have asset price, right? Okay, now, if anyone has ever taken um, calculus or physics, um, and they would like to let me know what the vega of this graph is, it's a pretty easy answer, and that's 0, because it's a straight line. Vega is, and that's why I think this is a little easiest to explain, it is the acceleration of, or sorry, no, gamma, I'm getting my freaking Greek slur. Gamma is the acceleration of the movement of price, or is the acceleration of the difference between options price and asset price, otherwise shown as velocity, which is delta, right? What I mean by that is this, right? If we have the change in asset price to an equal change in options price, what we have is a 0 vega, where that, or 0 gamma, where that change has no valuation on our asset price, which makes this market 100% efficient. It is very difficult to trade as an options trader in a 100% efficient market. Right? Now, let's make this market actually realistic, right? Can I even do that? I think so. I don't, whatever, okay. All right, and let's say it's actually like this. We can say, there's 5 contract values here. 690, 691, 692, 693, 694, 695. All right, so what we would have is, you know, maybe it's still up, it's continuously up, but maybe it's, maybe it's this. Where instead of that straight line, what you have is these changing accelerations based on these discrete asset price values, right? And that is what can be utilized as a metric to trade these inefficiencies in, right? You see, obviously these lines wouldn't have gaps, but they have these points of price discrepancy where in a constantly flowing, shifting market, these points change and show bigger, show smaller, and options dealers are able to, almost bid-ask spread utilize those acceleration differences. Also, then quickly, Vega is price sensitivity compared to volatility. Um, so what that means is, if we have down here, volatility should probably be our Y, but it's okay. Um, if we have extreme volatility, we're probably going to see pretty high options pricing. The only difference is, right, we can make this, right, all right, we can make this the money, all right? At the money right here is this blue line, all right? And this is going to be our volatility, right? If we have bullish, right, out of the money, right? Or sorry, if we have bullish inside of the money with high volatility, what we're going to likely expect is this increase, right? because we already have good amount of positioning inside the current range and are having increased directional movement, right, which we can attribute to volatility inside that range. Right, there could be other factors constricting that explanation, right? There could be a lot of other factors making that not anywhere near the case. But if we're seeing low vega but high volatility, if we're seeing low vega at all, since it's a comparative rate, if we're seeing low vega in a bullish market, well, and we're seeing high volume, we're going to expect some bullish continuation there, right? On the opposite side, right, bearish is a lot of times de-risking, de-exposure, right, deleveraging. So what we're seeing with that is when we have high volatility in a bearish market, right, that is a continued extreme bearish. Right, now if we have low volatility in a bearish market, right, we're probably going to have continued risk relegation because there's not a lot of volatility to correct. But if we have, high vega where we also have low volume in a bearish market, that could show, heavy risk, heavy implied risk on that day, on that session, and that's something we could utilize there. That is Vega's use there. Yeah, I think I kind of went through everything. Yeah, maybe I can break down some academic papers later, but I kind of want to pick them out a little better. I just kind of went through and looked at the topics that I wanted to talk about today. Didn't really do too much. So yeah, hope y'all enjoyed. All these videos. I think I've said this in literally every video, but I'm gonna keep saying it. So fuck you. But all these videos are probably gonna be under the same like chill format of not doing very much, just kind of talking about what I want to talk about and making videos. I'm probably gonna be making a lot of videos, just because I'm also learning some of the deeper concepts myself. And they say the best way the way you fully master something is if you can teach it. So if I'm making any degree of sense, cha-ching, But catch y'all in the next one. Thanks for watching. Like and sub.